Welcome to the Rich Dad Real Estate Show, where we talk about the good news and bad news of real estate, hosted by yours truly, Jaren Sustar. Guys, go down to the show notes and grab mine and Robert's free ebook, How to Buy Your First Investment Property. It's going to walk you through step by step everything you need to do to capitalize on real estate here in 2025. And I think 2025 is going to be one of the best years to invest in real estate that investors have seen in recent history. So today we have a good friend of mine, Ryan Bakke, on the show. Ryan is a real estate investor and a CPA with over 600 plus real estate investor clients. He's invested in over 10 projects ranging from small multifamily to campgrounds to hotels to skyscrapers. He's done it all, and he tries to help people save money. I guess stay out of jail and away from the IRS too, right, Ryan? I appreciate you being on this morning.
Yeah, it's been awesome. It's been a great journey. I mean, I started with like most people, I started with a house hack. I lived in one side, I rented out the other. I bought that house with only $3,000 out of my own money because I learned how to negotiate seller concessions and utilize an FHA loan. And I actually utilized tax strategy to save $6,000 that year in taxes when I bought that property. So I actually got paid to put that to buy that property that first year, and then it just snowballed ever since.
When you get paid to buy I teach a lot on buying real estate using other people's money, all different types. But when you actually get paid, I've done probably 3 deals in my life where I literally got money at closing. Mm-hmm. Dude, you talk about feeling like a superhero walking out of the closing session. It's a pretty amazing feeling.
Yeah, and I mean, to the person who's never bought real estate or doesn't understand it, it seems super confusing to them, but I promise it's not. You really have to understand the different types of loan products, like how much you have to put down. Certain loan products only allow certain seller concessions, a certain percentage of the loan amount. But once you understand the game and you know how to play the game, it's very similar to the tax code. And I consider it like a board game, because the first time you go to play a board game, you got to sit down with somebody and they show you how to play. And then a couple times later, then you're the one that's able to sit down and show people how to play. But once you understand the game, you can't not understand it anymore, and then you can use it to your advantage.
Did you start as an investor first and then become a CPA, or was it kind of simultaneous? Like how did CPA and real estate coincide? Because a lot of people are CPAs. That's maybe not a lot of people, but there's a number of them throughout our country. But they're not all in the real estate space. How'd the two merge?
So I was a CPA first. At least I wanted to be a CPA, and I was working at my first accounting job, and I prepared 2 tax returns. I had a tax return for a married couple that was making $200K a year, W-2. And then I did a tax return for a guy here in Chicago that was single, but he owned 17 apartment buildings in Chicago. And he netted in cash flow double what the married couple made on their W-2, yet he paid less in taxes than the married couple. And I remember, thinking I was going to get fired, or I did something wrong, or, something had to go wrong. And I asked my boss, he goes, no, it's because he invests in real estate. And ever since then, I've been trying to figure out exactly how real estate investors specifically can save the most amount of money in taxes.
It's an interesting journey. I think when people are getting started with building wealth, because you start with, and we've talked offline about this in our group, you got to make as much money as you possibly can. Like I think that is one of the beginning steps of building wealth is, how do I make more money? How do I buy more assets? But then at some point, there comes the time where you have to look and say, how can I, now that I got all this money coming in, not pay the government as much, and then preserve and protect my wealth over time? And I think especially newer real estate investors, they hear about tax benefits, but they don't really understand it. Like what are the tax benefits of real estate, and how does it evolve over time? So when you sit down and you're having a conversation with somebody, you're consulting them on their taxes, how are you laying out, hey, if you will listen to me and purchase this asset, this is how not only it's going to make you wealthy through appreciation and through cash flow and all the good things that come along, but here's what it's going to do for you on the tax side of things.
Yeah, and it's really easy to get confused or distracted, but we pretty much prepare a couple pro formas or projections, right? So we have a projection that is pretty much just cash on cash return only, like how much money is it going to put in your pocket? How much are you going to make as an investor once you factor in appreciation, equity pay down, tax benefits, and then this thing that I call inflation hedge. But the wealth building game, like to your point, first you have to build a tremendous amount of wealth. Like you have to build wealth through a high paying job, but eventually you'll realize that if you just keep that high paying job, you're going to get hit on the head with taxes. There's three main big killers to wealth that I tell people. It's taxes, inflation, and indecision. So even if you go and make a bunch of money, well, if you're not reinvesting that into, a business or a rental property or some type of investment, you're going to get hit on the head and you're going to get taxed a lot, right? So then I made, $100,000, but 30 grand of it goes to the government. So now I'm left with 70. Well, if it sits there in a damn bank account, now I'm losing value because of inflation, right? So now my 70, if I do nothing after a year, my 70 is only worth 65 purchasing power wise. And then it's the indecision. And my finance professor used to say, your opportunity cost is your opportunity lost. So if I sit there and don't do anything with that 65,000, it's like, what could it have grown to had I made a decision earlier in life to invest it into an asset? And I'll never forget this. Like I bought my first house in 2020, and this was like when rates got slashed. I bought my first house with a 2.85% rate. I'm like, should they loan money to a 21-year-old kid at a 2.85% rate? That's probably not a good idea. But I told my friend, I'm like, man, he had the same job as me, really got to get in on this, like, house buying thing. I mean, even if you don't want it to be a rental property, it's like, it's still cheaper than renting. And he's like, nah, I think it's too high. And then a year goes by. I think I had 3 houses in 1 year and he had none. He's like, nah, I still think it's too high. And then all of a sudden, I was at like 9 houses before my buddy bought his first one. And I'm like, well, finally you kind of came to the table. I mean, I've been telling you for the last 3 years, but that's what I'm talking about. It's the taxes, it's inflation, and then it's the cost of inaction, which arguably could be the highest out of all three.
Dude, I flipped my first house in 2016, really got into buying real estate in 2018, and bought a lot in 2019 and beyond. No joke. I mean this 100%. And those who listen to this show often, they've heard me rant about this. I was told every single year that I bought real estate that it was not a good time to buy. I'm telling you, 2016, 18, 19, 20, 21, 22, 23, 24, and then people tell me now it's not a good time to buy real estate. You know what I've been doing all those years? Just stacking assets and flipping properties to make profit. That's literally what I've been doing. They're still sitting on the sidelines, and their indecision has kept them in the rat race, has kept them middle class. And, part of it, Ryan, and I'd love to hear your take on this, I get it. I rant a lot about the indecision or the bad decisions that people make, but I can level with you guys, and I understand that we work hard for our money, right? So a lot of us work hard for our income. And we want to protect it. It's like put a little blanket around it. Make sure it doesn't go anywhere. So then to take money that we've worked hard for and then go deploy it in an asset such as real estate, where logically we know it's going to do well over time based on history, based on data, but emotionally it's very hard because it's the unknown, because it's not common to you. I get it. That can be a hard thing to do. But we have to look at what the numbers tell us, and you hit the nail on the head. If we're saving $70,000 after inflation and the purchasing power of the dollar, we're left at $60,000 purchase power. We're losing literal purchasing power on our dollars that we save. And so many of us are taught, middle class, save. What were you told growing up? I was. That's what everybody said. You got to save your money. It needs to be changed to you need to invest your money. I think it's smart to have 3 to 6 months of emergency fund in cash. I really do. I keep some cash on hand for rainy days. Outside of that, there should be no reason to have money that you are not investing in assets, because you're going to get absolutely hammered by inflation. And then to your point, you're going to get absolutely hammered by taxes if you're still working a W-2. Bro, I can't hide W-2 income. I don't know if you know a secret to be able to hide it. What do? You don't.
Short-term
you have
rentals,
to pay it.
But,
well, exactly. Yeah, the tax loophole. And I want to get to that here in a second. But on the front end, there's no hiding it from your paycheck. What can we do on the back end? You just mentioned something, short-term rentals. I'm guessing we're going to accelerated depreciation. If you're talking to that person who's making $100,000, $200,000, $300,000 a year, and they're saying, Ryan, I love single family, I love hearing all multifamily, all these different things. What are ways that I can reduce my tax liability right now through real estate? What would you tell them?
Yeah, I mean, first I would say it's definitely not their fault that they were inactive for so long that they didn't take action. I mean, we're definitely not taught in school how to buy real estate, but I would make sure that they understand the numbers, because a lot of times we don't need more time to think about doing something. We just need more information. And the sooner that you guys can understand pro formas and, how does math work? Like, how does it work in terms of, okay, if I could buy a house for this purchase price, it needs to do X amount in rent. And then as long as I can keep my operating expenses to a certain amount and my debt service is this percentage of the revenue, then I'll be okay. Like, once you understand that mathematical formula, math works in all 50 states, right? Except California. But if you can follow that formula, you won't lose on a property if you have a long-term holding period. The people that lose in investing are the people that don't have a long-term mindset. The market doesn't reward overly risky behavior. Okay, the market does not reward overly risky behavior, and it also doesn't reward overly safe behavior either. It's the right amount of risk with the right amount of knowledge at the right time. And just doing that thing over and over, like you said, just buying a house every year, even though people told you it was too high, like doing that same thing over and over is what's going to get you wealthy. But playing it super safe is not going to get you wealthy. And playing it super risky, like putting all your money in the new Trump coin, may not be a good play either. I guess maybe it was, but
what about the Melania coin? Do you think that one will do good? No, I'm joking. What if they take it a step further? What could somebody do? Like, what action could they take if they have a high income right now, W-2, and they want to offset that? You mentioned short-term rental, for example. Why did you say that? What are some things that folks can do to go and reduce that tax liability with different actions within real estate?
Yeah. I mean, long-term rental. So first of all, if you're going to fix and flip property or develop to sell, you're going to get hit on the head with taxes. So a fix and flipper gets taxed actually more than a W-2 person, and sometimes even more than a business owner, because the way that the IRS treats fix and flips, they tax the hell out of you. Now, there's ways to get around that if you also combine flips with rentals. So I remember working with one of my largest clients. They were flipping about 8 homes a month. And I told them, I'm like, look, guys, you really got to keep some of these as rentals to help offset some of the flip income. And fortunately, they did, and they were able to save a lot of money in taxes. But flips, you're going to get crushed. Long-term rentals, multifamily, you're not going to be able to get the full benefit of the tax deductions if you're not what's called a real estate professional. So if you're still working a full-time W-2 job and also investing in real estate, long-term rentals, multifamily, apartments, you're not going to be able to write that off against your W-2 income unless you're what's called a real estate professional, which means you're pretty much full-time. You or your spouse are full-time in real estate. And that's where short-term rentals come in, because there's a special carve-out in the tax code, and this is actually a loophole. So people call things a loophole in the tax code. Like, they say that, cost segregation is a loophole, or the 1031 exchange is a loophole. That's complete bull, because it's actually, there's a section, it's section 1031. There's a section for bonus depreciation too. But the short-term rental loophole is a legit loophole, because when they wrote that rule, they wrote that rule with small resort style vacation rental companies in mind. They wrote this rule before Airbnb and VRBO were even a thing. So they never thought that you and I, who had full-time jobs, could also own a property on the side and use that to our advantage and help offset our W-2 income. So that's why it's considered a legit loophole in the tax code, because if you buy short-term rentals, you can use that accelerated depreciation to offset your W-2. And man, I mean, we've seen clients do some amazing things. Like, I had a husband, wife, they were making $400,000 or $500,000 a year, both tech workers when they started with me. They actually had 2 long-term rentals, and we worked on divesting the 2 long-term rentals. And from 2021 until now, they bought 5 short-term rentals using basically the tax savings that they got along the way, as well as what they originally sold from the long-term rentals. And now they're making the same amount of money in short-term rentals, and they don't pay anything in taxes. So they literally make the same $400,000, $500,000, and they don't pay anything in taxes because of how the tax code is designed.
We'll be right back with Ryan Bakke.
Are you worried about your financial security in these unprecedented times? If you are, the next minute could profoundly impact your financial security. Imagine waking up to find the economy has plunged and your portfolio has plummeted 30 to 45%, while banks are in turmoil, holding your money hostage while waiting for FDIC intervention. Where would you turn? For many, this may sound like fiction, but it's a stark reality for those that have money on the line. Recently, America's awoke to both the NASDAQ and the Dow, plummeting over 1,100 points each and triggering a frenzy of sell-offs. History shows us how a single event can crash the market, like the dot-com bubble of 1999, the subprime mortgage crisis of 2008, and the pandemic of 2020. But today, we're facing multiple bubbles: commercial real estate, stock, bonds, and banks. Combined with the relentless inflation, the threat of global recession, the specters of war, and you have the perfect storm. The consequences could be catastrophic, plunging us into unprecedented crisis. America is sliding in the age of discord, with trust in institutions collapsing and the democratic norms unraveling. The quality of life for Americans has declined. Wealth is concentrated among the rich, while the median American family income stagnates, creating a dangerously top-heavy social pyramid. Moreover, hostile countries like Russia, China, and Iran are working to destroy the U.S. dollar. Gold is a no-matter-what store of wealth that you need. That's why Robert has been such an advocate of gold, and he trusts Allegiance Gold. Allegiance Gold is ready to help you incorporate physical gold as part of your portfolio and protect it against economic uncertainty. Visit protectwithrobert.com today to learn how you can qualify for up to $5,000 in free silver with a qualifying investment. Or give them a call at 844-3-ROBERT. Remember to mention Robert and Kim sent you when you contact Allegiance Gold. Secure your IRA or 401k today with Allegiance Gold. Visit protectwithrobert.com or call 844-3-ROBERT.
Welcome back to the Rich Dad Real Estate Show, where we talk about the good news and bad news of real estate. And I'm here with Ryan Bakke. So, Ryan, we were talking before the break about how there's a loophole in the tax code with short-term rentals, right? And how you mentioned the term accelerated depreciation allowed them to essentially recoup a lot of their money that they had put into the deal, so then they can go and buy more and more and more. And I think you said over the last few years, this high-income earning couple who were making $4,500K in W-2s were able to buy around 5 short-term rental properties that are absolutely crushing it with cash flow. They got all the tax benefits. So will you dive in a little bit on accelerated depreciation? Because I think it's one of those, there's a number of tax benefits to real estate, right? And, I'd like to touch on a few more before our time's over today, but one of the big ones is accelerated depreciation. It's talked about a lot, and you get a lot of big bang for your buck. So dive in a little bit and tell us, like, what exactly is accelerated depreciation?
Yeah, when you buy a rental property, there's a certain amount of tax deductions that you get buying a rental property. It's typically the purchase price divided by however long the useful life of the property is. So if you're buying, let's say, a long-term rental and you buy it for $275,000, well, the life of a long-term rental is 27 and a half years. So you would get 10 grand a year in depreciation if you did 275,000 divided by 27 and a half. But the way to think about depreciation is it's like a piggy bank that your mom or dad had for you when you were really young. See, I have this Winnie the Pooh piggy bank where you could only put money in it. You could never take money out of it unless you had to smash it to get into it. And my parents always told me when I was 18, I'd be able to get the piggy bank, but I still don't have it. But you can think of accelerated depreciation like that piggy bank. So you have this bank of tax savings that you normally don't get for 27 and a half years. Well, if you do accelerated depreciation, you get to smash into that bank and pull some of the money out a lot quicker. So most cases, you're able to pull 25 to 30% of the total tax benefits out of the property in the first year. And then the rest of the 70% of the benefits you take over the remaining life of the property, which, like I said, for long-term rentals, it's 27 and a half years. For like commercial or for short-term rentals, it's 39 years. So you really want to, because also too, the average hold period, most people aren't holding on to properties for 30 years. Once they hit a certain point, they're doing what I call a cash on equity analysis, and they're getting rid of it to go buy something else. But you're way better off by taking those tax benefits now, because time value of money says you'd rather have those savings and deductions now, because you could reinvest that money and then it's going to be worth way more than if you would have just kept it slow, straight line over 27 and a half years. Does that make sense?
That's a fantastic explanation.
Yeah.
It makes sense to me. Can you do that? What all assets can you do that in? So you mentioned commercial. So you can do short-term rental. When you say commercial, are you saying like apartment complexes, warehouses, things of that nature?
Pretty much any residential real estate you can accelerate depreciation on. Any warehouse, any commercial building, pretty much any real property, you can accelerate depreciation on. Now, there's certain times where it may not make sense, right? So if the purchase price is super low, sub say $250K, you may not want to accelerate depreciation on. There's some oddball cases where, let's say somebody wasn't working all year and they're just in a super low tax bracket. Well, you don't really want to accelerate depreciation if you're in a super low bracket, because you're going to be in a higher tax bracket in the future. You're better off just waiting until then. But as the case with most of our clients, like the ones that I brought up, you're going to be in the highest tax bracket of your life right now. If you're in the peak earning years, you're going to be in the highest tax bracket you'll ever be in. And so it makes sense to accelerate the depreciation and go from a 32% bracket down to, say, a 12% bracket, because later on down the road, you're going to be in a lower tax bracket. So why would you want to take the depreciation then when you could take it now at a double or triple the tax rate?
Yeah, that's a really good point. You hear syndication GPs and people who raise funds, they'll collect funds from investors and they'll go buy property. They talk about tax benefits. Is that similar to what we're doing with accelerated depreciation, or is that totally different? Like, where do the tax benefits come in with these syndicators?
Yeah, you have to be really careful about investing your money as an LP or in a limited partnership or a syndication, because as a limited partner, you're not going to be able to offset your W-2 or your business income with those losses. You can only offset your rental property income or gains with those syndication losses. So oftentimes, like, syndicators or promoters, they like flaunt the tax benefits, but really, if you're full-time W-2 and you don't have any other rental properties, that loss that you get, it just sits there on your tax return until you have income or a gain. Okay, so don't let them fool you that you're going to get all these tax benefits, because I've seen it happen. Like, I've seen people dump $100,000 into a syndication thinking that they're going to save $30,000 in taxes, and come to find out that they can't offset their tax situation. So now they still owe that $30K, and then the money that they were supposed to pay the $30K with is sitting inside of the syndication now.
Wow.
So don't let that be you, man.
I never knew that. I work with a lot of high income earners who will invest in the syndications for that purpose. They think they're getting these tax benefits. I got a lot of phone calls to make after this episode. Tell them, watch out, because they don't have other real estate, is what I'm saying. That is their only investment in real estate.
And I shouldn't say that you won't save money in taxes, because you'll be able to offset the income that you get from that particular syndication for a couple of years. Like most of our deals, or the deals that I've been a part of, like, you're not paying taxes on that deal for 3 to 4 years, because those losses that you have are offsetting the income each year. You're normally only paying taxes when you sell the deal or you get bought out, because that's when you get a huge gain and a big check. It's normally when you pay taxes. So, but you cannot take the loss from the syndication and use it to offset your W-2. I think that's what I want to be clear about.
Yeah, but still, that's fantastic information. That's something that I did not know that I think is super helpful. One thing I've always wondered about is, and you hit on this briefly earlier, the real estate professional classification.
Mm-hmm.
All right. So if you have one spouse who works a W-2, they obviously can't be a real estate professional. But let's say the other stays at home. What are the qualifications to be able to be labeled as a real estate professional?
Yeah. So for the stay-at-home spouse, it's fairly straightforward. They would have to work 750 hours in real estate. So whether that's they're an agent, real estate agent, they're doing construction or property management, or they're managing the properties that you own, they'd have to spend 750 hours, which comes out to be about 15 hours a week, by the way. They have to spend 750 hours in real estate. Now, that has to be more than their more than half their working time. So that's why a guy working W-2 can't qualify, because if you're an accountant working 2,000 hours a year, you'd have to spend 2,001 hours in real estate. So it's just not, I mean, we work 80 hours a week sometimes, but not every single week, So they're just not going to believe that. But if the spouse that's doing the 750 hours doesn't have another job, well, then they already qualify for that by getting the 750 hours. And then it really comes down to a fancy word called material participation of the rental properties. But I like to just call it, you pretty much have to self-manage your properties. So you got to hit the 750 hours, and you also have to self-manage your properties. Sometimes if you have a property manager, you're not going to qualify because they're doing more work than you are, is the argument anyway.
Very interesting. I did not know that about the property manager. And what are the tax benefits that come with actually getting that real estate professional tag?
Yeah. So very similar to the short-term rental loophole, you're going to be able to write off the real estate losses against your active income, W-2 or business income. So that's huge. I mean, real estate professional status has been around since 1993. The short-term, and it's right around then when they wrote in that short-term rental loophole, by the way. It was back in the early 90s. Of course, they didn't anticipate people like you and me owning Airbnbs, right? So it's the same benefits as short-term rentals in terms of you can offset your W-2 or your business income with the real estate losses. The other little thing I would mention is, just because I've seen it come up, is if you're a real estate professional, you don't have to pay what's called net investment income tax, which is a 3.8% surcharge on all investment income. So let's say you sold a property for a $300,000 gain, right? Well, in addition to federal capital gains, state capital gains, depreciation, recapture, you also have this 3.8% surcharge on the investment income, which on a $300,000 property comes out to be about $10,000. So we had a client where they were a new client, and one of the things we do when we onboard new clients is we review their previous year's returns. So this new client, she was a realtor by trade, but her CPA didn't mark her real estate professional because they didn't buy anything; they only sold properties. Okay. And they didn't think that it was a big deal not to mark her as a real estate professional. Well, it turns out if they would have marked her as a real estate professional like she was, she wouldn't have had to pay that $10,000 in investment income tax. So we were able to amend her tax return and get her $10,000 back because we knew that rule, because we're real estate CPAs compared to another firm that doesn't specialize in real estate. They're not going to know that type of stuff.
That's powerful. I hate the government taking so much money. You think Trump's going to abolish the IRS?
I don't think so. I don't think he'll come as far as to abolish the IRS. One thing I think they're pretty moving forward on are tariffs on companies that employ like out of country labor. So like these big companies that have, if you go to like India or Bangladesh or any of these companies, they're so tech forward. And they have like KPMG and all the big accounting firms and consulting firms, like they have skyscrapers in these other countries, having people work, for U.S. based companies. So I think something like that would happen first before like the IRS gets abolished, because they would make so much money by putting tariffs or whatever you call it on people who are. I mean, hell, they'd get my ass. I got 7 or 8, overseas workers for my accounting firm, but not that that's a lot, but I see that happening before the IRS gets abolished.
It's amazing how and I don't want to go too deep down the political rabbit hole, but the inauguration was yesterday. We were filming this the day after, and it's amazing how we've all just gotten accustomed to property tax. When the U.S. was founded, property tax was like a big no. That was part of why we came over here. And today we just, pay it. It's normal. Yeah, what do you want to charge me? It's absolutely insane, at least for our personal property. If you want to make an argument for an investment property getting taxed, whatever. Don't tax my personal home. How do you help people, Ryan? So somebody's buying real estate and they're like, dude, I don't have a CPA in my corner. And I can't stress how important it is to have a professional in your corner. I will tell you, not to go on a rant, I'm at the stage in my life through different businesses, through just experiences in life that I have learned, and people say this all the time, but I was very hard-headed and I thought I could do everything on my own, and I mean this, but I have learned now, if you will just put the people who are the best at certain things on your team to do those certain things and then get out of the way, life is so much better for you. Whether you do that in your personal life, whether you do that thing in business. And this is one of the things, having a CPA who knows the tax code, who knows real estate on your team to take care of everything for you, it makes life so much easier. And so what does that look like when people come in to work with you?
Yeah, we have a couple of different ways to work with us. I mean, first, I would recommend joining my Facebook group called Tax Strategies for Real Estate Investors. Got almost 12,000 active members inside of that group on Facebook. You can follow me on all social media. It's just my first name, last name, CPA. So Ryan Bakke CPA on Instagram, Twitter, TikTok, all social platforms. And then
for now, TikTok for now.
For now, TikTok for now. And we have pretty much anything for everyone at all different levels. So if you're just kind of starting off and you want to dip your toes on, tax strategy, I do in-person quarterly events in Chicago. So you come in, learn for 2-3 days, learn about the tax code and overall wealth building, legal structure as well. We have programs if you're just looking to get your tax return prepared by us. And then if you're looking to work one-on-one with a CPA or a tax advisor, we have another program that's you get your tax returns filed, plus you get one-on-one strategy calls. I also do a weekly call for all my clients so they can jump on and ask questions once a week and actually have me answer. That's the difference, I think, between me and other CPAs is you normally aren't working with the managing partner of the firm. You're normally working with a staff. I still get on one call a week with all my clients. I think that's what separates us from the rest.
I love it. I'm going to have you back on at some point to talk about corporate structure because we didn't have time to get into that today. And I know that's a question that a lot of people have. So, guys, reach out to Ryan if you have questions on any of this, plus the corporate tax structure that we didn't have time to hit on today. But Ryan, thank you for taking time out of your schedule. This information is so valuable. I learned a lot myself, and I appreciate everything you do.
Awesome. Thank you so much.
Thank you for tuning into this week's episode of the Rich Dad Real Estate Show, where I sat down with Ryan Bakke and we broke down tax benefits that come with owning real estate. Guys, 2025 is going to be the best year yet of real estate investing that we've seen in a very long time. Get in the game if you're not already. I've given you guys a free ebook down in the show notes that breaks down everything that you need to do to get started buying real estate today. Thank you for joining. I'll see you next week.
This podcast is a presentation of Rich Dad Media Network.